Continue. Right. Can you guys confirm that you can see my screen?
Yes, yes.
Okay, all right. So, welcome guys to Consider Your Portfolio 2026, hosted by Aino Miracle. So, my name is Aino Miracle. For those who don't know, my name is Aino Miracle, and I'm your host for this webinar. So, before we start, I want to thank you guys for joining. I want to thank you guys for the support, and I want to thank you guys for making your financial growth a priority. So, I'm joined last year and still joining this year. So, thank you guys for joining once again. Hello, can you guys hear me now? I think it disconnected at some point. Hello?
Yes, I can hear you.
Okay, okay, sure. So let's go to the index. Can you see my screen? Can you guys see my screen? Hello, can you guys hear me? And can you see my screen?
Yes.
Okay, okay. So we are starting today with the index. So this is what we're going to be doing for today. For some, it's not new to you guys, and for some, it's new. So let me just accept this person. Okay, move forward. Okay. All right. So this is what we're going to be doing for today. How does the stock market work? How risky the index? How does the stock market work? How risky is investing? What is index investing? Some of the ETF lists that you guys can invest in. Then when is the best time to start investing? How much should I invest? What stock brokerage should I use? Then emergency fund, high yield savings account, the Nigerian stock market, then how do you dollar cost averaging, then dividends, then understanding diversification in investing, then the last but not the least, Q&A, question and answers. So how does the stock market work? Generally, how does the stock market work? This is how the stock market works. First of all, when the stock market is just like when businesses look for investors, then when they look for those investors and they invest, let's say now for example, Dangote has cement, Dangote also has sugar, Dangote also has salt, and Dangote also has some of his refinery is currently ongoing now. So when people buy Dangote cement as a stock, when people buy Dangote sugar as a stock, when a lot of people are buying Dangote's sugar, Dangote cement and stuff like that, the market continue to rise. But when people say, when there is a market manipulation and people say, no, we don't want to buy Dangote's cement, we don't want to buy Dangote sugar and stuff like that, the market, Dangote's stocks will start declining. So this person said, someone is still in a shade today because someone planted a tree long time ago. That's, let's say, for Nepo babies and others, if their father invested in stocks long time ago, they won't have to start investing now. All they just need to do is start eating their father's money and all that. So let's simply put, the stock market is made up of many buyers and sellers. The stock market is made up of many buyers and sellers. When there are more buyers than sellers, the stock market will rise. But when there are more sellers than buyers, the stock market will decline. So the stock market comprises of thousands of different companies. The stock market comprises of thousands of different companies. It's different from crypto, it's different from Forex. It's just like having a physical business and you want people to help you invest in your physical business. Let's say now I'm starting a business and I don't have funds or stuff like that. Maybe I have funds to start it up, then I want more people to invest in that business. That's when you put it in the stock market. That's why it's different from crypto. Crypto is digital assets and Forex is just like trading is trading different currencies, foreign currencies. But this particular one is investing in businesses, in physical businesses, in people's physical businesses. So, like you said, the stock market comprises of stocks from thousands of different companies. Each share of stock represents a small portion of ownership in that specific company. So this is it. If Dangote Cement offers to maybe go public, obviously it's public, and you say you want to buy a stock of Dangote's shares, this is what's gonna happen. You are going to own a part of Dangote's sugar, a part of Dangote's sugar is it cement company. Or if it's Dangote sugar that you invested in, you are going to own a part of Dangote's sugar company. So every company has a different number of stocks available for purchase. Every company, if it's Elon Musk Tesla, he has his own different number of shares. If it's Dangote Cement or Dangote Sugar, he has his own different number of shares for people to purchase. I want to confirm that you guys can hear me. So how does the stock market work now? When you purchase a stock, even if it's one share, you become a partial owner of that company. So for people that own Dangote shares, for people that own Elon Musk's Tesla shares, you become a part-time owner. You know that you are one of the owners. Even if you are driving Tesla now, you know that at least you are one of the owners of the company. You are not just a consumer. You are not just driving Tesla because Tesla is beautiful, Tesla is and all that. You are one of the owners of that company called Tesla. So when you purchase a stock, even if it's one share, you become a partial owner of that company. Company issues this is the reason why company issues stock. Company issues stocks as a way to raise money rather than borrowing it in form of debt from bank. Stocks are sold to large number of investors and all that. So in summary, when a greater number of people opt, when a greater number of people want, when a greater number of people wants to buy want to purchase a company's stocks rather than sell it, the stock prices go up. Conversely, when more people decide to sell a company's stock instead of buying it, the stock prices decline. So how does the stock market work? Still continue. Imagine a company as a pizza. When you own more of the stock of the company, you own a bigger slice of the entire pie. So this is a pizza. Ownership of companies divided out in the form of stocks. So this is a pizza, and this pie is, let's say this pie is the whole of Dangote stocks. and you said you want to buy Dangote stocks, but you don't have the money to purchase large quantity, you can purchase a slice. You can purchase a small quantity. That doesn't stop you from being a part-time owner of Dangote's shares. So that's it for this one. So how does the stock market work? Continues like the New York Stock Exchange alone. The New York Stock Exchange is made up of over 2,800 companies and is the world's largest stock exchange by total market value, because it's difficult to track every stock to gauge how the stock market is performing. Professional investors will typically look at indexes. And what are indexes? Indexes are to in a layman's understanding, indexes like now, let's say like the S&P 500 is an index fund. Why is it an index fund? Because it collates all, like let's say it's for S&P 500, it collates the 500 most important companies in the US. The Apple stock, Amazon, Google, Facebook, Meta, and all that, even Tesla, and all the companies you can think of, Nvidia, and all the companies you can think of. The S&P 500 is an index fund because it collates and it tracks how all these 500 US companies perform. So that's why new investors and even maybe professional investors look at indexes. Why do they look at indexes? Because when you invest in an index fund, this is just like a basket of stocks in one. When you invest in an index fund, it gives you access to almost the most important companies. You have it as an asset in one basket or stuff, and something like that. When you have it, when Apple is going down, Nvidia can be going up, so you have a balanced portfolio. When Amazon is going up, Nvidia can be going down, so you have a balanced portfolio. That's why indexes are good. Indexes are good because, like I said, it can, let's say, indexes are good because when you have those number of stocks in one stock, it makes you not to lose to the market volatility. It makes you to have a balanced portfolio. So when other stocks are going down, some stocks in the index fund can be going up, so you not lose outrightly. So that's why indexes. But if you invest, let's say you went and invest in an individual stock, you went and invested in Apple, and Apple is going down, your portfolio will be going down because what you invested in is an individual stock. Let's say you invested only in Apple, you did not invest in this index fund now. When Apple is going down, your portfolio will be going down. If you bought Apple for 200 USD, when it goes down by 50%, you have 100 USD. But if you invested in an index fund, when Apple is going down, Nvidia can be going up. And when Nvidia can be going down, Apple can be going up, and Amazon and all that. So that's why index fund is good for new investors. Then what is the S&P 500? Like I said, S&P 500 serves as a benchmark representing the stock performance of the 500 biggest US companies. It's just like I said, think of it as a stock of a 500 companies combined into a single stock. Stock of 500 companies combined into a single stock. And then that single stock is used to gauge the overall performance of the US stock market. Do you understand? So if a company in the S&P 500 index starts to fumble, turn unprofitable, and lose market valuation, it will get putted out and replaced by a better company. That's what I'm trying to explain. If Apple is going down, and Nvidia can be going up, and Amazon can be going up too. So that's why index funds are good. And this S&P 500 is a US stock, is a US index. We'll still get to Nigerian index funds too. So like I said, meet the S&P 500, Google, UPS, Apple, HP, Fossil, Costco, Coca-Cola, and all that. Nvidia, S-Trade, Ford. So this is it. So let's go to the next one. So Nigerian Index Fund, we have ETFs, exchange traded funds. That's ETFs. It's also called index fund. So we have the Stanbic IBTC ETF 30. This tracks the 30 index the 30 Nigerian index and aims to replicate its total return. These are the 30 ETFs. To show you guys, 30 ETFs, MTN is there, Stanbic Bank is there, GT Bank is there, and all that. Access, Dangote Cement, Dangote Sugar is one of Stanbic ETF 30. Vetiver Grieving 30 ETF tracks in the top 30 Nigerian stocks. Then New Gold ETF tracks the price of gold bullion commodity ETF in Nigeria. So this is the NGX 30, MTN, Airtel, Dangote Cement, BUA Cement, Stanbic, Zenith Bank, GTCO, BUA Foods, and all that. So if you buy the Stanbic ETF 30, it's going to be tracking all these most important stocks in Nigeria: Stanbic, Zenith Bank, GTCO, Access Corp, ETI, Geregu, Seplat Energy, Nesto, and all that. So this is the NGS 30. So guys, please confirm that I'm not talking to myself. Please, I want to know that you guys can still hear me.
Yes, we can hear you.
Okay, thank you. So another thing is NGS mutual funds. We have mutual funds: Vetiver Money Market Fund, Stanbic IBTC Money Market Fund, ARM Equity Funds. So all these mutual funds, what they do is to gather people's money. Once they gather people's money, for example, this Vetiver Money Market Fund now, they gather funds from investors and then let's say, invest in, what's it called again? This Vetiver Money Market Fund, they gather funds from people, invest in treasury bills, invest in government funds, and then pay dividends annually and all that. So, and that's what most of these mutual funds do. They collect investors' money, then invest in treasury bills and other funds. Then let's go to difference between mutual funds and ETF. ETFs they are exchange traded funds. They can be traded on the stock exchange, but mutual funds can just be traded in somewhere like Cowrywise. They collect people's money and invest in, like you said, a mutual fund puts money from investors and is managed by a fund manager who invests according to the fund's objective. Like Vetiver invest in maybe farm and other. You also invest in government treasury bills, Vetiver Money Market Fund. Then an ETF, like I said, a mutual fund pulls money from investors and is managed by a fund manager who invests according to the fund's objectives. So when you are investing in a mutual fund, you should know what. Let's say you are investing with Vetiver, you should be able to know that Vetiver, this is what Vetiver is going to use your money for. Do you understand? If you are investing with Meristem, you should know that this is what Meristem Mutual Funds, know that this is what they're going to use your money for. Then ETF is a fund that also pulls investors' money, but is traded on the stock exchange like share and usually tracks an index. So Vetiver Money Market Fund is a money market mutual fund in Nigeria designed to help investors earn competitive returns, and is a low risk investment by pulling their money together, investing in diversified set of short-term, high-quality money market instruments. Then that's Vetiver is managed by Vetiver fund managers. Mutual funds are best for hands-off investors who want professional management. You gather your money, you give to them, they will invest, but you can do it, all these things. This mutual fund, you can see it on Cowrywise most times. Cowrywise. I use Cowrywise to invest, so that's why I'm recommending it, Cowrywise. Then ETF, then these ETFs too, you can also, Cowrywise is also available for stocks investment. You can also use it to buy Nigerian funds, invest in Nigerian stocks. ETFs are best for conscious long-term investors who are comfortable with the stock market. But this mutual fund, the thing there is that you don't have to worry about what the market is doing. They are going to pay you your dividend annually if you leave your money there. Then if you also want to, this is good for short-term investors. If you just have your money and you don't know what to do with it, you can invest it and it can be generating you income annually. It depends on what they are investing in and what percentage you are paying. For Vetiver, I think they are paying 16% annually, depending on the amount you invested. Then how it works. instead of holding cash in a bank and your money is put with other investors professionally and managed and invested in short-term debts and or money market instruments such as government, like I said, government treasury bills, commercial papers, bank acceptance and certificates of deposits, fixed tenor deposit with banks and financial institutions. So that's where they invest your money. Then the main goal of Betterment Money Market Fund are to preserve your capital and reduce risk of loss, provide liquidity so you can access or redeem your money relatively easily. Once you invest in Betterment Money Market Fund through Cowrywise, you can also be able to get your money if you don't want to invest again. If you are done with maybe they are if they are done with the dividend when they pay you and you say you don't want to invest again, it's easier to collect your money from them than maybe the ones trading in the stock market that can take days to withdraw. Then how risky is investing? Comes from not knowing what you are doing. That's why I always tell people, know what you are doing. I've had experiences of people who just tell me, I just want to invest. I don't know. I have money to invest. I just want to invest. Once they invest, another thing is that they will call me saying that the money is going down. I want to collect my money back. Even someone close to me, the person have not learned, but she saw that I'm doing it. She invested. All of a sudden she collected the money back. So that's not how to invest. You should know for someone if you're someone that has experience, you will know that the market fluctuates. So if you are investing, you know that you are investing it for a long term. Warren Buffett said, and I quote, if you cannot hold a stock for 10 years, don't think about holding it for 10 minutes. So risk comes from not knowing what you are doing. This is usually one of the first questions that new investors will ponder when it comes to investing. So once you expose yourself, once you know this is how the market works, you know that you don't have to worry about the ups and downs because in the long run you will still win. So when it comes to investing, the risk you expose yourself to is dependent on the investment strategy you establish at the end of the day. The first key to successfully investing is to minimize your risk. Minimize your risk and maximize your return as much as possible. To begin, we will discuss the greatest risk of investing, which is emotional. And this meeting, am I recording it? Okay. I think I'm recording it. Let's check. Let me check be sure that I'm recording this. Okay. Recording. Okay, it's recording. So, Ireland, I'm recording it. So you have the video at the end of it. I saw your text message on WhatsApp. So you have the video at the end of the day.
That's good.
Okay, yeah. So
Right.
emotional risk is often the hardest challenge investors face. Emotional risk, you watch the market, so they like you'll be like, why is this market acting like this? You want to take your money back. But if you are able to manage your emotions, you can control your money. Because emotions will make you that's why it's advised. If you need that's why and again that's why we have emergency funds. If you know that you will need this money in the next year, in the next 2 years, we put it in emergency funds or you put it in a high yield savings account. Emergency funds is for maybe when you are sick or maybe when your mother is sick or maybe when your father or stuff like that. You can go and get the money. You don't invest those funds for your long term. That's why if you have your emergency funds, you have your high yield savings account, you have your savings account, then you have your investment account. You have your investment account where you invest, then all those high yield savings accounts, you need to have all those accounts before you start investing so that it's not when something happens, you start and touching your investment, the investment for the long term. And also, you need to have IRA, that's called individual retirement account. You invest there, you invest there for your retirement. So everything is planned. So if you cannot control your emotions, you cannot control your money. So this is how if you have all these funds in check, there is no way the market will move you. And you know that you are not even in for now. And another thing is, if you know that you are not in for now, you don't want the gain now, you will know that you don't have any, the market is not even bothering you. Do you understand? So that's it. Emotional risk is often the hardest risk investors face. Fear of loss and all that. So if you can manage your emotions, you can control your money. And how do you manage your emotions? Know that understand that there are ups and downs in the market. understand that, and then have your emergency funds, have your high yield savings account, have your IRA, which is individual retirement account, and have your the main investment account, and also have checkings account. Checking account is account when that you can use, that is easily accessible. Maybe when you want to buy foodstuffs and when you want to go out and enjoy yourself and all that, you can have a checkings account so that you will not touch all this money that you are, maybe your emergency for your high yield savings account and your investment for the long term. So if you have all that in check, you will not have to worry about what the market is doing. And it's also advisable, if you are having your if you have your income, it's advisable to invest maybe 20% of your income, then keep some percentage for your high yield savings account, keep some percentage for your emergency fund, and keep some percentage for your checkings account, where you get money easily to do whatever you want to do your daily activities and all that. Then another thing is short-term risk. Short-term risk. Day trading is short term. I don't do day trading. I only do investing for the long term, because short-term risk is making, when some short-term risk is for day traders. Day traders, if you buy, maybe someone tells you that I just did a trade and made some money, you want to do that too. But if you're investing for the long term, you won't bother about this short-term risk, because the market is obviously moving up and down. It's just like they are doing, what's it called? Kia na Bazuna. Kia doesn't, like, if they are doing betting. You want to check if the market can give you this. But if you are investing for the long term, you won't worry about it, about this short term risk. Day trading is an investment about that often appeals to new investors. They hear stories of someone and stuff like that. However, these new traders quickly realize often that losing some or even all of their money, that day trading is far more difficult and complex than it seems. So if you are someone that is working, you invest for the long term, you don't need day trading, because at the long run, long-term investors always win. But if you want quick money, maybe you want, and you know how this thing happens. If you trade and get money quickly, you want to do another one. So and the market takes the one that you even have. They takes the one that you already have. So short-term risk is not good to day trade. It's not good to day trade. So it's good to, if you are doing your job, you invest. If you are doing your job, you invest for the long term and know that you're holding it for the long term. Then at the long run, you also win. Then long-term risk too. Over the long term, investors generally deliver much higher returns than short-term strategies. This is because long-term investors don't try to time market dips and recoveries the way short-term investors do. Instead, they focus and ride out the market natural ups and downs. The second key to investing is to think long term. To think long term. The first key, like I said, the first key to investing is to minimize your minimize your loss and maximize your return. Then the second key to investing is to think long term. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. That's what my Warren Buffett said, one of the greatest investors. So let's go. Then diversification is good to diversify. What is diversification? Diversification is just like, if you have a portfolio, let's say if you are investing in stocks now, and you know that there is Apple stock, there is Amazon stock, there is on the Nvidia, there is Tesla. It's not good to go and carry all your money and put in Apple, because you know that Apple will be, maybe will be $600 one day, or maybe 1,000 USD one day. It's not good. So it's good to diversify. It's either you put your money in Apple, you put in Nvidia, you put some, and then you put some in ETFs and mutual funds. That's how you diversify. You invest in international stocks, you invest in local stocks, you invest in mutual funds. You diversify your investments and diminish your overall risk by investing your money across multiple stocks in different industries. Like I said, like if you want to, the different industries, meaning that you can invest in tech industry, Apple, Tesla, Meta. You can invest in maybe farming industry, Dangote Foods, Dangote Sugar, Dangote Salt, Boa Foods. You can invest in energy, Seplat Energy, and all that. Then you have that's what it means to have a diversified portfolio. You invest in different across multiple industries. You don't can carry your money and put only in energy. Meanwhile, there are some that are doing tech. Meanwhile, there are some that are doing farming and all that. Investing all of your money into a single stock is much riskier. Is a much riskier approach as the value of an individual company stocks tends to fluctuate more dramatically than the value of stocks in the diversified portfolio. And that's why indexes are good because indexes help you diversify in multiple stocks in one stock. The lower the risk you take on diversification is the key to investing. The lower the risk you take on diversification is the third. Okay, the third key to investing is diversification. The third key to investing is diversification. Diversification in diversifying your stocks in different portfolios in different industries. So the threat of inflation. So what is inflation? Simply, inflation is gradual increase of prices over time. Like we are in Nigeria now. If you had 100,000 naira 2 years ago, and you have 100,000 naira now, what 100,000 naira can buy 2 years ago, it can't buy it now. So that's why buying stocks is good. Okay, protect your money. It will protect your money from inflation. So what is inflation? Simply put, inflation is the gradual increase of prices over time. And why does inflation matter? Since our goal is to build wealth, earning a return greater than inflation rate is essential. So allowing your money to increase in value over long periods of time is fortunate. Do you understand? Unfortunately for us, like the stock market has historically yielded average return of around 10% per year after accounting for inflation. The average stock market returns amount to roughly 7 to 8% per year. So if you are someone that is investing, inflation doesn't matter to you because as the prices of goods are rising, your money is also rising. So you are ahead. Do you understand? So you are ahead. That's why sometimes if you have your money in a savings account, maybe in a commercial bank, you have a savings account and you have 100,000, and next 2 years you still have that 100,000. Meanwhile, your purchase power has reduced because of inflation. So that's why it's good to invest and it's good to diversify. Because if you don't invest, this inflation, maybe the money you have, your purchase power will be reduced in the coming years. So that's why inflation matters. Now, we go to what is index investing. What is index investing? Index investing follows a passive investment strategy aiming to replicate or mirror the returns of popular indexes such as S&P 500. Then long-term investing is more effective than short-term investing, and a diversified portfolio helps you bear less risk than a portfolio that is just one-sided. Do you understand? And our investment strategy should involve investing in index funds, allowing for automatic portfolio. Maybe when you invest, automatic portfolio means like when you are doing dollar cost, when you invest, maybe you have an account and you link it to your brokerage. When you say when they pay you salary, collect 10% of my account and invest in this fund. Does that. Carrywise, you can automate through Carrywise. You can also I think Bamboo in their recent updated this thing. You can also automate your investing on Bamboo. So diversification index investing offers several advantages. For instance, research indicates that index investing typically outperforms professional investors who select individual stocks over an extended period. So, like I said before, index investing is just like investing in one stock that is comprised of different stocks, different industries, different stocks. Is a just like a basket of stocks. That's why index investing is good. Follows a passive investment strategy aiming to replicate or mirror the returns of a popular index such as S&P 500 index. So how can I invest in index funds? How can you, some people ask, how can we invest in index funds? You can invest through Bamboo, you can invest through Cowrywise. So all those apps allows you to invest. They have, if you look for the S&P 500 in Bamboo app, you see it. If you look for Stanbic ETF 30 in Cowrywise, you see it. If you look for NGS 30 in Cowrywise, you also see it. So the beauty of index investing lies in the ability to become an index investor simply by investing in exchange traded funds or mutual funds. An ETF is typically an investment stock actively traded on the stock market. And you can think of an ETF as a collection of stocks combined, like I always say, combined in a single stock. In this way, ETFs are already diversified for you. So it's easier when you invest in ETFs, it means that you don't have to do the work of diversification individually for yourself. You just have to just buy the stock. It's already properly diversified. That's why new investors are advised to go for ETFs and Stanbic ETF 30, S&P 500, Nasdaq 100. So these are the ETF list, like S&P 500, Nasdaq 100, Dow Jones, Russell 2000, emerging markets. You can see some of these stocks in Bamboo. You can see some in RiceVest. You can see some in Cowrywise. So, but the most important one is in this S&P 500. Nasdaq 100 is also good. So when is the best time to start investing? The right time is now. A famous Chinese proverb says, the best time to plant a tree was 20 years ago. The second best time is now. So this wisdom applies to investing, as the best time to start investing is right away. Do you understand? Because if, like I said, if you don't have a plan for your money will have plan for itself. Oh. So that's it. The earlier you establish and consistently contribute to an investment portfolio, the more time it has to grow. If I'm 30 years today and I start investing to $200 every month, and somebody is 20 years today and they start investing the same to $200 every month, by 10 years, the person will have, by maybe next 20, if in the next 20 years, what I will have maybe when I will be 50, or what the person will have when they will be 40 will not be the same. The person will still have higher chances of having more money than me. So it's good to start investing earlier on. If you started investing 10 years ago to $200, you know how much you would have had. And that's why when the more you grow, and you did start investing when you were younger, the chances of the price you pay will be higher. But if you started earlier, the price you pay will be lower. You even be doing it relaxed and making more money. So that's why it's good to start. Then what is compound interest? Compound interest is the compound interest is the interest calculated on an investment, which also include all the accumulated interest from previous years of that same investment. So what is compound interest now? Let's say you invested, okay, it's even explained here. Let's say for example, if you earn 5% a year and initially invest $100, at the end of the first year, your investment will be $105. After the second year, you will earn $5, 5% interest on the 105, not just 100. That's compound interest. Okay, let's say if you have $100 now and you earn 5% per year for the $100, what you have is $105. Then in the second year, they will not give you percentage. The compound interest, this compounding now means that they will not give you percentage in this $100. They will give you percentage in the 105. And 5% of 105 is not just 100 that you invest. That 5% of 105 will now be 110 after 2 years, not just 110. I don't know if you guys understand. Maybe after this, you guys can still ask questions if you don't understand. So this compound interest, if you have let's say if you have $200 and the amount it's used for annual the annual yield is 5%, then 5% of $200 is $10. Then for compound interest, this is what it means. If you have $210, you know that your initial capital is 200 and you earn 5%, which is 210. They will not pay you only 5% of that 200, they also pay you 5% of 210. And that's how your money begins to accumulate. I don't know if you guys understand. If you have, okay, I don't know if you guys understand, but let's continue. If you don't understand, you can ask questions after this thing. Just write down your questions, then I'll answer after the class. So that's compound interest. If you have, let's say if you have 100 USDT and your 100 USDT is supposed to yield 5% interest. 5% interest of 100 USDT is 105. Then you now start trading with 105. They will now pay you. The compound interest means that they will add a percentage to that 105. And what we have is 110. More fact, I don't know if you guys understand. You can unmute your mic so I will know.
Yes, yes, we understand. We are grabbing your point.
Okay. So let's go to the next one. How much should I invest? It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. Robert Kiyosaki said that. So regardless of your income, and if you're asking this way, how much should I invest? You should be able to know that how much you should invest depends on how much you are earning. Like I'm earning $200 per month. Someone else can be earning $500 per month. So if I said you should invest 20% of your income, my own if I have 20% of $200 and 20% of $500 is not the same thing. And if you want a higher return, if you want a faster return, you can even invest more for the long term. Regardless of your income, your investment should be based on your financial situation. This allows you to set investment goals, providing a target to aim for and motivation to start with a plan. Develop a strategy that enables you invest portions of any money you receive, whether from a paycheck or another revenue source, while creating your investment plan. So how much did I invest? Continue. A good general rule to aim for is, like I said, investing 20% of your gross income. But the more you can invest, the better. And investing anything is better than investing nothing. Sometimes maybe you have 1,000 or 5,000. You said that it's small to invest. There's nothing small to invest, because if you add 5,000 to 20,000, it's 25,000. If you add 1,000 to 20,000, it's 21,000. So it's better to invest something than not to invest at all. The fourth key to investing is consistency. The fourth key to investing is consistency. If you can only invest $20 each week, so be it. Start saving that amount and begin investing in the market as soon as possible. You'll be surprised how quickly even a small investment can grow. So that's it. Then some stock brokerages, like I said, Bamboo Robinhood Trading 1212, Cowrywise. Bamboo Robinhood Trading 212, Cowrywise. Then emergency funds. Emergency funds are money set aside specifically to cover unexpected expenses or financial emergencies without having to borrow or sell investments. So like I say, if you are someone that wants to start investing, you should have your emergency fund in check. So if you have emergency fund, okay, like when you have emergency, you not have the need to go and touch your money elsewhere, to go and touch the money you invested. Emergency funds are meant for unplanned situations such as medical emergencies, job loss, or sudden income reduction, and all that. Then high yield savings account. A high yield savings account is a type of savings account that pays a higher interest rate than regular savings account. PiggyVest is a high yield savings account. You can save your money in PiggyVest with a higher interest rate. Cowrywise, you can also save your money in Cowrywise with a higher interest rate depending on how much you are saving. You can save in USD in PiggyVest, and they pay you annually. They give you the interest percentage for USD, and also if you want to save in Naira, they pay a percentage. They pay a higher interest than commercial bank. They pay higher interest than commercial bank. So a high yield savings account is a type of savings account that pays a higher interest rate than a regular savings account. Higher interest rate earns more than standard savings account. Low risk, your money is exposed to stock market fluctuations. High liquid, you can withdraw your funds when needed and all that. Then the Nigerian stock market. Nigerian stock markets surpassed 100 trillion in total market capitalization, reflecting strong investor enthusiasm and rising equity valuations early in 2026. So 2026 started on a positive note for the Nigerian stock market. So that Nigeria is mobilizing funds for energy transition and climate-focused investing. So that's so why is this news even important? It's important, like they say Nigeria is mobilizing funds for energy transition. That's then why it matters is because structural reforms can boost investor confidence and attract foreign capital. That's why energy sectors like Seplat in it. That's why maybe if you have seen others people talk about you have seen people talk about Seplat energy. Nigeria is aiming to invest in energy. That's why if you invest in these stocks now, in this Seplat energy now, you'll be able to you have higher returns. The stocks is because the first time I posted it as a reel, it was around 4,000 something. Now this stock is 6,000 something. So if you buy it now, you are still on the positive side. Do you understand? They are willing to invest in energy, and this guy is doing well in Nigeria. So it's good, it's a good buy. If you want to buy, it's a good buy. And I'll still show you guys other ones too. Then blue chip stocks too, like MTN, Bua Foods, Dangote Cement, they're also going to do well this year, and even more than this year itself. MTN Nigeria, MTN is like the stock is running 600 and something now. Then Dangote Cement and Bua Foods. So all these stocks are going to do well. MTN Nigeria, Bua Foods, Dangote Cement, Seplat Energy, and all that. So you can invest if you want a long-term investment. They also pay dividends, so you can invest in it. MTN Nigeria, Bua Foods, Seplat Energy, Dangote Cement, they're all good. So what is dollar cost averaging? What is dollar cost averaging? So dollar cost averaging is a proven way to take advantage of long-term investment opportunities while removing tough decisions about timing, buy and sell orders. So let's say dollar cost average. How does dollar cost averaging work? This is how it works. You can say I have, let's say they pay me 200K a month, or I make 500K a month from my business, and you want to buy S&P 500. S&P 500 is currently 500 and something USD. Or you want to buy NGS Stanbic IBTC ETF 30. You want to buy it, and you said, I want to invest in this stock for long term. This is what I'm good. This is what dollar cost averaging does. You say, I want to invest 30,000 in S&P 500 or in a Stanbic ITC ETF 30 for 5 years. I want to invest in 30,000 every month. So this is what's gonna happen. This is how dollar cost averaging works. You will be investing that. You say you will be investing that 30,000 every month. Maybe the bamboo will be taking 30,000 naira from your account every month, whether the market is high or whether the market is low. So if you said you are going to be investing 30,000 naira every month, that's your dollar cost averaging. You are doing like you are investing whether the market is high or whether the market is low. You are investing the same amount consistently every month for maybe 5 years. So dollar cost averaging helps you buy more when the market is down, and also whether the market is high, you also buy. But when the market, that's why it helps you not to time the market. It helps you not to even like bother if the market is going up or high. What you know is that you are going to buy this same amount for the next 5 years. And it gives you opportunity to even buy more. Let's say if the market is down now and you use 30,000 naira to buy, you buy more. And maybe the market is up, and another time the market is down. What you know that is you are buying consistently for 5 years, 30,000 every month. So that cost averaging is a proven way to take advantage of long-term investment opportunities by removing tough decisions about timing, buy and sell orders. Focusing your efforts on investing consistently over time. yields better results than trying to time your investments perfectly. Dollar cost averaging of this year is sometimes called the constant dollar plan. The constant dollar, that's if you are, well, it's US people that wrote this. It can be dollar because US dollar cost average, because that's why it's dollar cost average. It's not naira. Do you get? So you can also say I want to be investing 30 USD every month consistently for the next 5 years, or as it is sometimes called the constant dollar plan, means consistently investing a certain amount of money in a particular security over time. Security can be bamboo, security can be cowry, security can be trading 212. The investment pattern should be followed regardless of what's happening in the market. So regardless if the market is going up or the market is going down, you can buy $30 worth of this same amount of stock every month for 5 years. So that's what dollar cost averaging is. So you guys be writing down your questions just in case you don't understand anything. This strategy helps you reduce your average buying price during a market down, gives you a cushion against market volatility. You will be spending small amounts of money over time, which means you'll be buying stock when the prices are low and also when they are high. This ultimately averages out the price of the stocks over time. Another benefit of dollar cost average is that you don't have to invest so much of your time and effort keeping tabs on the market. So I think Bamboo now gives access. If you want dollar cost average, I think you have to put your account number there, tell them how much you want them to be taking every month and all that. Since you follow a regular investment pattern, you should be obvious to the continuous market ups and down and all that. So that's what dollar cost averaging means. So this is just a pattern. This is just a pattern. So this person, if you want dollar cost average now, you can see this thing. The person is investing the same amount when the market is down, when the market is high, when the market is down, until it gets to the time he says he doesn't want dollar cost average. It's okay. Do you understand? You can see, as you are seeing the graph, when the market is down, he's buying. When the market is up, when the market is investing the same amount over time. For instance, if you earn $2,000 monthly and allocate $200 of your salary to your pension plan, out of 200, you could opt to invest 100 in S&P 500 fund and 100 in another mutual fund every month. $200 will be decoded for your salary and invested in the two funds, no matter the price. Do you understand? Like I said, as you're seeing the graph, even when the market is up and down, the people they are still buying. They are still dollar cost averaging. So that's what dollar cost average, buying when the market is up and when the market is down. You don't bother. And when the market is down, obviously you buy more when the market is down. And when the market is up, you buy less. But it's still the same pattern, the same amount at the end of the day. So some people will say, why I don't want dollar cost average, I want to invest a lump sum. There is the risk of lump sum. Like in a lump sum, if you have, let's say you have $2,000 now, you say I don't want dollar cost, I want to invest that $2,000. There is a risk in it, because the thing there, you might lose your money. Maybe not really lose, it might go down. You'll be able to you have more opportunities to invest more and have more when you dollar cost average than when you invest a lump sum immediately. So a big question many investors ask when they have built up chest of funds is whether to opt for dollar cost average or to invest in lump sum. To think this through, consider these three aspects: your risk tolerance, your ability to stay consistent and stick to your investment plan. How long can you hold on to the investment? If you want to do a lump sum, how long can you do $2,000 for how many years? And how your risk tolerance, not when the $2,000 is dipping now, you want to sell. Do you understand? That means you are selling. So it's always advisable to dollar cost average than to put a lump sum of money in investments. When you dollar cost average, when the market is down, you buy. When the market is high, you still buy, and all that. So dollar cost averaging benefits. Dollar cost averaging strategy is easy to start and understand, and can be followed by novices as well as maybe professors, professionals. Here are a few main benefits of strategy. Not timing the market. With dollar cost averaging, you don't have to invest efforts to time the market, since the market is often unpredictable. DCA keeps you safe from mistiming the market and making the wrong calculations or investment decisions. So fewer emotions, long-term gains, you gain more at the long run. If you dollar cost average, you gain more. Because when the market is, especially if you're dollar cost averaging, when the market is down and when you're still buying the same amount, you tend to have higher amounts of stocks or higher amounts of shares for for the company you are buying. Especially if you're investing in index, you have the number of companies inside one stock, you have higher amounts and all that. And also S&P 500, all these ETFs, they pay dividend. So if you invest a lot of money, you also have you have a passive income, and you also still have the share in your portfolio. And dollar cost averaging is automatic if you set it up. I think Bamboo made their own automatic. Piggyverse also made their Cowrywise also made theirs automatic. Think I've explained this thing. That the dollar cost averaging means investing a certain amount in a stock or ETF consistently. You may invest the amount weekly, monthly, annually. The key is persistence, no matter the market fluctuations. Dollar cost averaging depends on two main factors: the amount you want to invest and how regularly you want to invest the same amount. You need to determine first and the total amount you are willing to spend. For example, if you're investing $100 every month, you need to make sure you can invest that same amount. You don't start with the amount you cannot continue with. Through thick and thin, make sure that you can invest this same amount regularly. So, how long depends on how long you want to invest it. How long depends on how long you want to do it. You can choose 5 years. Some other person can choose 10 years if they can do it regularly for 10 years. The main thing is consistency. If you are saying you are doing it for this long, then you are going to do it for that long. Then know that this is how long you are going to do it. Whatever amount you are thinking of investing, you need to plan out how to invest it and follow the plans strictly. So that's it. So why is dollar cost averaging good? It reduces the risk of investment and is an effective strategy to keep your capital safe from market volatility. So this year, dollar cost average also keeps you in the market, whether high or low. During down periods in the market, your purchase price reduces and you get to buy more shares when the price is low. Then when there is an up market, you have the opportunity to sell and stuff like that. What is diversification in investing? A diversified portfolio is where total investment allocation is split among different industries and businesses to reduce risk. When you diversify in different industries, it helps you to reduce risk. The reason is that selecting a poorly performing stock in a good industry is possible. It's also possible to invest in many trading instruments in a given industry, only for that industry to witness a downturn. So that's why you should have a diversified portfolio. So it's just like diversification in investing continues. Just like this particular one can be tech, this particular one can be farming, this particular one can be energy. Do you understand? In other words, the more your portfolio is spread out among different securities and industries, the more protected it is against any adverse events that may happen. So if you invested in energy, you invested in farming, you invested in tech, when energy is going down, tech and farming will be going up. It means you have a balanced portfolio. But when energy is going up and farming is going up, tech can be going down. You still have a balanced portfolio. That's why it's good to diversify. Don't just put your money in one industry. Diversification in investment is an essential principle of wealth preservation. If all of your stocks are in the tech market, you might see impressive gains if the market goes up, but you could lose everything if the market goes in the other direction. That's why it's good to spread your allocation among different industries. How to create a diversified portfolio? There are many different opinions and theories or whatever. But the thing there is that you can invest your stocks in diversified portfolio means you have to have a stock in a tech industry. You have to have a stock in a farming industry. You have to have a stock in an energy industry. That's a complete diversified portfolio. And also another thing, ETFs helps you do that. ETFs helps you do that. Index fund like S&P 500, NGX helps you do that. All those in a basket of stocks in one single stock. So ETFs helps you do that. So let's go like this for particular one now. How to create a diversified portfolio. This particular portfolio now, see, US stocks now, 30% is allocated to US stocks. 15% is allocated to first world international stocks. Emerging markets got 5%. So this is a complete diversified portfolio. If you want to have a complete portfolio, a complete diversified, a proper diversified portfolio, US stock markets, first world international stocks, US stock markets got 30%, first world international stocks got 15%, emerging markets 5%, government bonds, 15%, treasury bills, treasury inflation protected securities, 15%, then real estate funds. You can invest, you can invest in real estate even without having a proper land. Yeah, you can invest in REITs. You can invest in REITs. That's what it's called in the stock market. You can invest in real estate even without having a proper land. You get paid from when people sell lands, when people sell land, when people sell houses, you get paid annually, you get paid dividend. And maybe when the stock increases in price, your portfolio also increases. So this is a balanced portfolio. Then you can add NGN stocks, and NGS 30, you can add MTN, you can add Dangote Cement, you can also add BUA Foods, Seplat Energy, and all that if you want to have individual stocks. Then, like I said, this totally explained it. Then how to create a diversified portfolio. So any like it's explaining here, any market can go crazy, any market can go up, any market can go down, or any industry can go up at a particular time, and the same industry can go down at a particular time. So if you invest in diverse industries, it means you have a proper portfolio and all that. So remember that any sector or market can go bust at any time. Diversifying across asset classes is a good way to offset this risk, regardless of the total dollar amount. The amount is not relevant to a diversified portfolio. Also, remember that asset allocations are not absolute. There are successful investors with diverse asset allocations. You can have 100% diversified stock portfolio or diversification within the real estate market and stuff like that. Four primary components of a diversified portfolio. If you have domestic stocks, this will nearly always feature heavily in giving portfolios. Some stocks can generate dividends. Domestic ones that generate dividends can be like NGN stocks, the domestic stock. They call it the domestic stock. It can also be local stocks. Do you understand? Local stocks, NGN stocks, pays dividends. You can invest in it. Then international stocks. Local stocks, like I say, local stocks are just like domestics are just like local stocks in your country where you are they have stocks. So NGN stocks is what it is. Then you can invest in international stocks, UK stocks, US stocks, and Canadian stocks, and even Chinese stocks and all that. Then bonds. Bonds generate fewer returns than stocks but are safe. They offer protection from stock market risk and set a rate of return for lending out your money and all that. Okay. So let's go. So using diversification across time. Another form of diversification refers to time, also known as dollar, like I've said this thing before, dollar cost average. This is mainly a hedge against. So you can't possibly gauge all the variables in terms of price movement. This helps to mitigate timing risk. This talking about dollar cost averaging. Start investing early, multiple assets, dollar cost average, geographical diversification. It's just talking about the same thing. The longer you stay invested, the better you can optimize dollar cost averaging, like I said before, while mitigating short-term price volatility. Multiple assets mitigate risk by holding less correlated assets classes such as equities, bonds, currencies, and other assets. Dollar cost averaging, investing equal amounts regularly can help lower the total average cost and avoiding time risk. Investing across different sectors and locations can help reduce concentration risk and all that. So you can invest in US stocks, you can invest in Canadian stocks, you can also invest in Nigerian stocks and all that. It also helps you to have a proper diversified portfolio. Advantages of diversification investing: reduces market volatility, preserves wealth, reduces management, more successful, and maybe peace of mind and all that. Then it has anything that have advantages has disadvantages. Maybe you can reduce your rate of return, longer to build wealth, and can be taken too far. Then dividends. Dividend investing is a popular strategy for generating passive income. Dividend investing is a popular strategy for generating passive income and growing your wealth over time. But to maximize the potential returns from your dividend, it's important to understand the key dates in the dividend process. So how does dividend work? Dividend are cash payments that company will pay to its shareholders at regular intervals, usually quarterly. They pay out of the company's earnings. Dividends also help companies attract investors and provide you as an investor with regular income. Reinvesting the payment received or even allows you to purchase more stock in companies that you own for free. So dividends are payments that company make maybe at the end of annually after the year they calculate, and then by percentage of the stock by percentage of the company, then they pay you what you earned. Once they calculate the percentage, they pay you based on what you are holding and the amount you are holding and all that. So what's important about dividend is the dividend date. You can also choose to, if dividend date is important, because you can also choose, let's say you're holding a UBA stock or shares. Maybe you're holding 250K naira worth of UBA, or 5 million naira worth of UBA stock or shares, and UBA announces their dividend date. And they say if you hold our stock for so before the dividend date, they will pay you this. If you have you can also use it to make money. Maybe if you have 5 million worth of UBA shares and they declare the dividend date. So this is why it's important. If they declare the dividend date and you have 5 million that you want to use for something, you can also use that 5 million to buy the UBA dividend, and they will pay you 10 million, and they will pay you the percentage of the 10 million shares that you own without having to know whether you have been holding it for a year. So long as you bought it, maybe they say that you should have it a week before the dividend date, or a week before they pay out the dividend. So you can use it to make more money. I don't know if you guys understand. If they announce dividend day, you can also use it to make more money. Maybe you can buy it a week before this thing. They pay you based on that percentage. You also take out your 5 million and use it for what you want to do, and you take out the gain. Maybe you can also reinvest the gain, or maybe use it for whatever thing you want to do. So companies pay dividend regularly, most often quarterly, alongside any reports. Here are 4 important days you should know. Declaration date. Declaration date is when the company announces it's paying the dividends to investors. On declaration statement is released which includes the size of dividend payments. It's on this date that you learn how you get paid, how much you get paid. Then ex-dividend date, the last date the company paid dividend, that's what the ex-dividend date is. The ex-dividend date is the date by which you must own the stock to receive the next payment schedule. The next scheduled payments. Do you understand? If you purchase a stock before ex-dividend date, you are entitled to the next payment. Likewise, if you bought the stock on or after the ex-dividend, you are not eligible. So if you bought a stock before the dividend date, If you bought a stock before the ex-dividend date, you are likely to get paid if you bought it. Do you understand? That's why the share price is dropped when it goes ex-dividend. The price is adjusting for the fact that the shares no longer include an entitlement to receive the coming dividend payment. Like I said, the ex-dividend is date by which you must own the stock to receive the next scheduled payment. So the record date, aka date of record, is similar to the ex-dividend date. You must be on the company's book as a shareholder and all that. So next are the important ratios. Know when analyzing which dividend stocks to buy. So dividend yield. The dividend yield of a stock is company's total payment to shareholders for the year, expressed as a percentage of its current stock price. Dividend yield is total dividend divided by stock price times 100. Then you know how much the company is and how much the company earned. Total dividend divided by stock price times 100. Using the form, you can work out dividend yield of a stock. So if a company trades as 120 USD and the dividend per share is $6 annually, to work out the dividend yield calculation is as follows: total dividend divided by stock price times 100. So that's how to calculate dividend yield. So 120 divided by 100 equals to 0.05. Then 0.05 times 100, dividend yield is 5%. So let's say now UBA total dividend, UBA trades at 120 USD and price per share is $6. So the dividend yield will be 6 divided by 120 equals to 0.5. 0.5 times 100 equals to 5. It will be 5%. So some dividend yield changes over time if the company decides to increase their dividend. Then dividend investing from dividend payment ratio. Another way to think of dividend is as a cost to the company offering it. If a company starts earning less income, the prudent thing for management is to cut costs, one of which is dividend. The problem is that management won't always do the prudent thing the right way and all that. So payment ratio, dividend per share. There's also dividend payment ratio or dividend per share or earning per share. If a company B has dividend per share of $2 and earning per share of $4, then their payment ratio will be 50%. If company B has dividend per share of $2 and earning per share of $4, then their payment ratio is 50%. Oh my God. Thank you guys for joining the session. I don't know if anybody has any questions to ask. Then let me show you guys the stocks to look out for this year, especially Nigerian stocks. They are really doing massively well. So Okomu Oil, I don't know, Okomu Oil, Presco, Cadbury, for consumer goods, Cadbury, Bua Foods, Dangote Sugar, Guinness, Nestle, Unilever, and all that. Unilever, Access Corp, First Bank, Fidelity Bank, GTCO, Stanbic, Zenith Bank, UBA, MTN, and Airtel, Free Airtel, Boa Cement, Dangote Cement, and Seplat Energy, and Total, and Aradel. Those are also the stocks to also look out for. Oil and gas, Seplat Energy, Aradel, Total. Industrial goods, Dangote Cement, Boa Cement, and WAPCO. ICT, MTN, and Airtel. Then for financial services, Access Corp, First Bank Nigeria, Fidelity Bank, GTCO, Stanbic, Zenith Bank, UBA. Then for consumer goods, Boa Foods, Dangote Sugar, Guinness, Nestle, Unilever, and all that. Then NGX 30 is important. NGX 30 is important. It tracks the most important. All these things I called are under NGX 30 as an index fund. They're under NGX 30. Then for mutual funds, Betiva, Meristem, Betiva and Meristem, and all that. So thank you guys. So I don't know if anybody has a question. I don't know if anybody has a question. Okay. Okay. I'm asking you to unmute, John Paul.
Good evening.
Good evening.
Thank you very much for your time and everything.
Okay.
Ma, please. This emergency funds. I want to ask. So, where can we put our money for emergency funds? Like, where can we put our money for emergency funds?
Okay, for emergency fund, you can save your money in Cowrywise. You can save it in Cowrywise for emergency funds. Do you understand? Or put it in OPay. But I said Cowrywise
Yes.
so that if you put it in Cowry, if you are saving it in Cowrywise, they will pay you interest. So Cowrywise is okay for emergency funds. You just save it there. You just put it there. But because when you want to withdraw, it doesn't take time to withdraw. You can save it in Cowrywise.
Yes. I also use Cowrywise, but I don't know which option there. I will just put the money for emergency fund because
Yes,
I
they
invest
will give you
in
option. You will see on
um,
Cowrywise.
mutual funds there.
On Cowrywise, you will see option for emergency funds. If you go to Cowrywise, they have option for emergency fund. So you click emergency,
Okay,
then
okay.
you are going to be saving the money there. Do you understand? Can you hear?
Okay.
Okay. I don't know if there's any other question.
Yeah, I understand that. Thank you very much.
Okay, welcome.
Like I also want to ask about I also want to ask, is there any USD account we can easily open from Nigeria here? Maybe USD account we can be saving in dollars.
Okay, you can save in dollars using Cowrywise, using PiggyVest. You can save in USD using
Me too.
PiggyVest, and they pay you interest when you save in USD. So you can open PiggyVest account and save in USD. Are you?
Piggy vest.
Yes,
Okay.
PiggyVest. PiggyVest. Once you pay your Naira into PiggyVest, they convert it to USD for you.
Okay.
And buy USD from PiggyVest and then save it in USD. They pay interest.
Okay. Thank you very much.
You're welcome. So I don't know if there's any other person that has a question. Does anybody else have a question? Okay, thank you guys for joining and see you again next time. So Ireland, I'm going to I'll send the link to the video to you so you see it. Thank you guys for joining.
Thank you so much. God bless you, ma'am.
Welcome.